The market considers equity as a share of a corporation's revenue stream after all earlier commitments and debts have been paid. In an equity definition, the share price is the relative value assigned to the corporation's earning potential depending on a variety of criteria. These include general economic circumstances, both in the industry and generally, earnings prediction, predicted company growth, corporate stage of development, and financial ratio analysis. There are three key versions of equity to examine while analyzing what is equity and its meaning. The three basic types of equity. Common stock is a type of stock that indicates ownership in a firm. Common stockholders partake in the corporation's profits stream through dividends paid and capital gains realized on a per-share basis. Common stockholders are responsible for the election of the board of directors, the appointment of senior officers, the selection of an auditor for the corporate financial statements, dividend policy, and other corporate governance issues. This can also be done using proxies, in which a third party is granted the shareholders' ability to vote on their behalf. Because of the duties connected with common stock, the investor has a higher stake in the firm's fortunes. Capital gains accrue to common stockholders to a higher degree than to preferred stockholders due to an increase in the market price of the firm's shares. Common stockholders also have several important rights if the company is liquidated. Restricted obligation to the firm's creditors and a residual claim on any assets or income obtained after all preceding claims have been met. Preferred stock is stock in a corporation that has a fixed dividend and a first claim on earnings for the common stockholder. In the event that the firm ceases operations, preferred shareholders are reimbursed any liabilities owing to them. If the board of directors suspends a dividend for whatever reason, the preferred share normally has a cumulative condition requiring that any unpaid dividends be paid in full before any dividends are announced and paid to common stockholders. This indicates that, in comparison, the preferred share is a more secure investment. In order to make the preferred share more appealing, the firm issuing it may add several features to it. Convertibility into ordinary shares, call provisions, and other characteristics comparable to those utilized in the fixed income market are included. Because of its guaranteed dividend stream, many people associate preferred shares with a type of fixed income security. However, in exchange for the extra security provided by the assured dividend stream, the holder of preferred shares gives up the power to vote on corporate governance concerns. As a result, the favored shareholder has limited influence on business policy. Warrants are a type of option that is typically attached to a corporate bond issue or preferred stock to sweeten the sale. A warrant is a long-term option that permits the owner to participate in a company's capital gains without purchasing ordinary shares. In effect, a warrant holder has a leveraged bet on the company's common shares. A warrant is a type of option with an exercise price and an expiry date. The exercise price is the price at which the holder can convert the warrant into the issuer's common stock. The expiry date is the final day that the warrant can be converted into common stock. Given that a warrant is often offered to lower a loan issuer's costs, the expiry term is frequently more than 2 years after issuance. This permits warrants to trade independently of the bond with which they were issued, giving the investor a long-term option on a company's common stock. Drawbacks of warrants as a form of equity. There is a disadvantage to include warrants under the what is equity umbrella, particularly for income-seeking investors. A warrant, as an option, does not provide a dividend and is susceptible to price compression when the underlying stock approaches or exceeds the exercise price.